I want to address something I keep getting when I go on the media. That most analysts and economists are saying, well, the stock market, yeah, it's bubbled up, it's gone up strongly, and it hasn't corrected, but they're saying it's not, it's fairly valued. Well, the price-earnings ratio on the stock market, the traditional one, is 17 times earning. Now, at major tops in the past, like 1929 or 1965 or 68 and so on, and 87, 22 was as high as it got. The only time it got higher than that was the tech bubble, and that was the strongest confluence of cycles in history. And when we predicted that, when nobody saw it, that the baby boomers, the largest generation in history, would be spending at the highest rate of their life cycle, and these internet and computer and cell phone and broadband cycles, kind of like automobiles and electricity in the roaring 20s, would be in an S-curve acceleration into the economy. That's when the economy's great. We're not growing at that now. This recovery is artificially driven by the Fed and central banks around the world, and despite unprecedented stimulus, the U.S. has only grown at 2%, Europe's barely growing or still in recession, Japan's just tripled their stimulus and they're barely growing and can't even create the mild inflation targets they're looking for. This is not an ordinary economy, but the thing I want to stress the most comes from a cycle that I brought into our work in early 2006 called the geopolitical cycle. Go back the last 200 years. For 17 to 18 years, things will be good in the world, no major wars and conflicts and things like that, or big inflations or deflations, and then for 17 to 18 years it'll go the other way. And the last cycle was very clear, 1983 through 2000. Nothing went wrong in the world. So when we had that tech bubble with the greatest productivity, 2-3% productivity and 4%, economic growth, GDP growth and stuff, baby boomers spending at their best. We were in a great geopolitical cycle. The worst thing that happened in that 18-year period was we had a 100-hour war with Saddam Hussein. He invaded Kuwait, we kicked his ass, and pulled back out. That's all that happened. Well, that has not been the case since then. 2001, when this negative cycle kicked in, and by the way, it lasts into 2019 or 2020. Let's call it 5 to 6 more years. We had we had 9/11, which really kicked it off. We had the Iraq War, which was a disaster and didn't work out well. The Afghan War, which we couldn't really win and had to pull out of. The whole Arab Spring across North Africa, from Morocco to Egypt, Tunisia, Libya. We had the Syrian Civil War, which is still going on full blast. And then Iraq started falling apart after we left. Surprise, surprise, that 3 warring factions throughout all history couldn't get along, and that the government was favoring the Shia side, and now the Sunnis are revolting. And they've got an out-and-out civil war there that is only starting. And we get Israel finally invading Gaza. Can't take any more bombs and insults and kidnapping, so we're just going to have to declare war against Gaza. And, of course, Ukraine and Russia, and that just heated up when a bunch of crazy pro-Russian rebels, it looks like, with equipment supplied by Russia, shot down a commercial airliner, either because they were a little tipsy or they thought it was a cargo or a warplane or something threatening. This is not 1999 or 2000 or 1929 or 65 or 68 or 87, where we've seen major past peaks, or 2007. The worst geopolitical trends we've seen in our lifetime, the highest debt and debt ratios around the world, twice or more what they were at the roaring 20s debt bubble peak. Governments artificially stimulating, keeping the bubble going, stretching it farther and farther. 17 price-earnings ratio on the S&P or Dow is high. It's extreme. 26 on the small caps. It's extreme. But again, if you look at Robert Shiller's cyclically adjusted price-earnings ratio, which is a much better model, earnings go up and down like a yo-yo, and they bubble and burst. He takes the average earnings of the last 10 years and compares them to prices. And you get much better indicator. His indicator shows we're at 26 times earnings. And that is higher than every major peak except for early 2000 with the tech bubble in 1929. This is higher than most peaks in the past and up there with others. This says the stock market is very overvalued and could peak at any time. And the market keeps edging up and people keep saying, well, the Fed won't let it burst. Investors are the most complacent I have ever seen them except for early 2000 of the tech bubble. Investors think the market can't go down because it won't go down and the Fed won't let it go down. When markets keep edging up with less and less correction and bubble like they have, and this has been a true bubble trajectory since early to mid 2013, you are getting ready to peak. My thing is, I don't care what causes the bubble. I don't care what people argue. It's not a bubble for whatever reasons. They always do this. If it looks like a bubble, walks like a bubble, quacks like a bubble, it's a bubble, damn it. And this is a bubble, and it's going to burst. And I only see a couple percent on the upside. We, for a long time, have been saying, look out for around 17,000. We get real strong trend line resistance through the past tops in 2000, 2007. Each new bubble's taken us higher, but each crash takes us lower. We're at a little over 17,000. We're right at that point. We might go a little higher, but I don't think much more. We've got extreme resistance, you know, through tops at the S&P at 2,000 or a little higher, and we're right close to there. I say the market has a couple percent upside in the next few months at most for it peaks, and it's got anywhere from 65% or higher downside in all the market patterns we look at. This is a time to be selling stocks on rallies. Do not be complacent. Do not listen to the pundits. They've all become bubble cheerleaders. That's what people do. Bubbles take people into denial. Nobody wants the bubble to burst because the consequences are too extreme, especially with the debt in our world. People don't want the bubble to burst because everybody's getting a free ride. Stocks are going up in a crummy economy for no good reason. It's stimulus driven. This liquidity put in by the Feds and central banks has to go somewhere. It's not going into lending. So it's going into creating bubbles. That's the inflation, not the gold bug inflation of consumer prices going off the charts. It's asset bubble inflation. And a lot of stock markets are at new highs. A lot of real estate markets around the world at new highs, more overvalued just about than ever. This bubble's going to burst. Don't get greedy. Better to get out a little early than late. Just example, the first crash in the tech bubble in early 2000, the first leg down, it eventually went down 80%. The first leg down was 40%. Better to be a little early than a little late. Thanks for listening.